Everybody, a little cooler over here today in this part. We appreciate y'all coming. I'm Kevin Charleston from Specialty Risk Insurance. I got Brian Youngblood here. I'll let these guys announce themselves here in a second. But what we've been all over the country this spring working on livestock risk protection. And so we thought this might be an opportunity with the 4-State Farm Show over here. We do a lot of work with Aaron and Lance, and just opportunity to have you guys here on a pretty good day to talk about this. But we'll get into it in just a second. I'll let these guys announce themselves over here too.
I'm Skylar Moore, Joplin Regional Stockyards, one of the owners, family business. And
I'm Corbitt Wall, Canyon, Texas, with DV Auction and the Feeder Flash Daily Market Report.
Yep. So we'll just, what we were going to do today is just lay out probably what we see is go to the next slide if you don't care. This is on livestock risk protection, and I'm sure a lot of you have heard a lot about this. Man, it's really hard to follow all the different stuff. We were just talking earlier. Everything in the world there's a lot of information out there that's swirling around. And so what we thought we would do is just show a couple coverages up here, and then we'll kind of work backwards into exactly how it works. But if you, the lowest, and you can buy as high, at 99% coverage all the way down. This is the lowest we could buy off contracts offered, Brian.
Yep.
Up here at 88% of the board on these 8-weights. These are 8-weight steers for an 8-15 contract, a 13-week contract. And this was a few days back. That board's a lot less than that today. But this was back in the spring. And at 162 would have been your coverage price on these cattle weighing 800 pounds. It would have cost you $3.92 for the steer. So we just went to the lowest, the cheapest coverage you could buy, cheapest coverage level you could buy. What was the board yesterday on those 8-weight steers for August?
It was like 165 and change.
Right. So you're kind of floating around that point. It's about a $20 for, and then up to the highest coverage we could at this date. We're just using this date as an example. Was one head on 800-pound steer at 182.47 is what we could have protected that steer at. It cost $4 a hundred or $32 a head. So that kind of gives you the variables, and we're going to work into how this works as we walk through this. And I'll kind of let Brian go to the next part of it. We're going to show you some settlements that are coming out pretty quick if they settle today, and then we're going to walk back into how all the fundamentals work with that. So,
okay, go ahead and go to the next slide there. And you guys have all this. You can follow along with us where you can kind of see it better. So these are, and I won't go through every one of these here. You guys can look at it, but we'll start with this top row here. So this policy here, this was wrote back on February 23rd, I believe, is when I wrote this policy. It's on a set of heifers that their target weight was 575 pounds. With an ending date, May 25th. So what are we, just 5 days away from this policy maturing? So as you can see, the producer chose a coverage price of 172, and that's per 100. So as of yesterday, the index, 2 days ago, the index closed at 153.46. And what that index is, that's the CME 7-day national cash average of the feeder cattle. And that's how the LRP is settled. That's how it's, you're choosing your coverage price, and the difference between the index and your coverage price is how you get paid if there's a difference there. But on this particular scenario, it costs the producer $17.20 to insure that. At this time, if that does not change at all, which you guys can attest to this, do you see much change? If it's going to change anything,
next 5 days.
Next 5 days, it's probably going to go lower the way things look. But if, let's just say it's 153.46 on them 1,500 head, that's a total insurance indemnity or payout of $134,100, or $89.40 a head, and that is above the premium. So that is net, I don't want to say profit, insurance that producer is receiving to cover the loss from the market decline, okay? So that is what the LRP is for. You know, we always say it's for a major catastrophic event. You know, COVID was a huge cause of the market to decline whenever it came out. Major droughts are back when, what was the
Fire.
the packing plant, whenever it burnt. Anything like that causes the markets to just have a negative effect on us. And we have no control of that, so LRP is a way that we can protect ourselves, and we're protecting only the bottom side. So we're leaving the top side open, so if the market rallies up and goes high, then we make that up on the high cash price. On another one, let's just pick them 190 head of steers right there. It has an ending date of June 7th, and that policy there was wrote there in March, I think the second week of March, if I remember correctly. Those are some 8-weight steers. They chose a premium or coverage price of $168, and there again, we're just about 2 weeks away or 3 weeks away. We're just going to use the same index showing you the difference, what the insurance is going to pay you, about $15,000 on just them 190 head, or roughly $80 a head is what the insurance is covering in the loss. So those are just some real time or real scenarios of how the LRP has worked.
Let's roll to the next page if you guys don't care. Now we'll kind of step backwards here and talk about the different fundamentals that go into this. So you can you can buy a coverage price from, like on that first example, 99 point whatever percent. You can buy a coverage price up to that level. So if it's 150, I'm just going to use that as an example. Say if it's $1.50 on those cattle, you're at $1.47, 48, or 49. That's the highest level you can buy from a coverage point. Down to about 88% is what they typically offer. They say you can buy down to 70%, but they're not offering contracts that low. We can't buy it that low. So that's why we ran that example in the beginning, and that kind of ties back to the coverage prices up there. Now, one of the things that makes this really hard, not hard, but it's a little different. You're buying off the board price, but the CME index is how this settles out. And that will vary from the board from week to week. So that's a 12-state running average, and we'll get into that with Corbitt in a little bit. He'll explain that a little bit deeper, but that 12-state running average is on average on feeder cattle 6 to 8 99s and 6 below 6 on those cattle, and we have 2 different contracts on those cattle. So anyway, you can buy them. The shortest contract you can buy is a 13-week contract up to a 52-week contract, and all the variables in between. So they just have to be offering out there at 52 weeks. If there's no contracts out there, then we can't get it done for you. But as far out as they'll let us, we can set that and turn that in. The policy is 1 to 12,000 as of July 1st. It's still like 6,000 right now on each one, on each particular. You can do one set of cattle up to 6,000 and have 2 sets of cattle on there for a total of 12. As of July 1st, it goes to 12.5 and up to 25,000 head. But it doesn't matter if it's 1 head or 6,000 on each endorsement. I mean, we can do that anytime.
Can you tell them a little bit about how, when you're hedging through this policy rather than the board, you don't have to have a potload of cattle to hedge them, right?
Right.
1 head.
Right.
So, I think that's something that's a big draw for small producers.
That is a key thing, because a lot of small producers, they don't have 50,000 pounds of steers or heifers or to put together to be able to sell or be able to buy a put or a hedge. So with LRP, you can. If a guy's got 50 cows and they want to protect, their 25 steers, they can come out and buy a LRP policy. You can do 25 steers or 25 heifers, whichever. So it's all by the head. It's not by the load
Yep, it's not, and that's why it's designed for every size cattleman, from that guy that's got 10 cows in his backyard to these guys running thousands of mama cows, if you want that, or yearlings, whatever. It's designed for kind of, I mean, that doesn't catch a lot of the guys over at 25,000. That catches most, but it's designed. It was the original concept was the smaller producer, but it's grown into where it'll set up for either, you know, up to larger producers. So that the LRP, we talked about the CME index, and I tell you what, this might be a pretty good time for Corbitt Center to talk about the index, so they kind of explain it to them on how that settles out, because that, remember, you buy it off the board and it settles out off the index. And so it doesn't matter what your cattle bring. Remember that. Your cattle just have to, that was when you're going to market your cattle. You gave us an ending date when you were going to market your cattle against that. Your cattle will be sold separately. This is just a protection against the board in the CME index from the variable from that. So keep that in mind. Other thing to keep in mind, and they're changing this just a little bit, you just have to own the cattle when you buy it and to within 60 days of the end of the contract. And they just lifted that, we think, yesterday for the drought area in the west, but I think they're going to open up across the country. So if you just own the cattle when you buy it, that's what they're talking about. That's not written in stone yet.
That's not permanent either. That's just a.
It may just be short term.
It's a short term.
But if you catch a drought in June and you got it set up for August, you can sell your cattle. This is why it's designed that way. So I'll let you talk about the CME index a little bit.
I think that's one thing that draws me to this way of protecting yourself, is because you buy it off of the board. I mean, you have to have something to look at down the road. Well, it seems like the board is always advertising more than what we ever get. And I talk about it all the time. It looks like a mirage out there, and the closer you get to it, it goes away, and it just dries up on you. Well, you can buy it off those big old prices. Well, it settles on the cash.
No.
And that's what the CME index is, the cash. And what it is the average of the 7 to basically 900 pound, 899, because the reports break at 9 and start going up. But 7 to 900 pound steers in all the sale barns that you have a marker reporter sitting in up through the middle 12 states, from Texas and New Mexico all the way up to North Dakota. And so that is what makes your CME index. They run a 7-day average on those, and that's what your cash price is. And when I'm talking about the RTI, the real-time index, we're using our information in the same exact situation to try to be a precursor to that, because ours is always current and theirs is lagging behind a day and a half, but it gives you an idea where it's coming. But it is truly what the cash market is. And the nice thing about it being a 7-day moving average is it's not as volatile as the board is. And so you're getting ready to start selling your cattle, and things are getting shaky, kind of like they are right now. We just had kind of a bearish cattle on feed report come out an hour ago. You're nervous about it. You done told Skylar that you're bringing the cattle Monday, and he's nervous about it too, and things are going like that. But your payoff on your index, it's a 7-day moving average. It's not going to hurt and jerk like your board does. So, you know, who knows what's going to happen? Maybe the board's down 11 Monday or 3 times next week. It's not going to move the index, the cash index level, that much. So it gives you a more secure payoff. And like he said, you can have fancier cattle and they could bring way more than that price, or you could have junk and they could sell below, but it's just going to be in relation to where you bought that, and it doesn't have any effect on really what your cattle brought. It's just a protection from the market. But you know, you haven't talked about how you can get subsidies to help pay for some of these premiums.
That's coming up.
Coming up.
We like to skip around. We lose track.
I would have talked about that first.
You know, just touching on what Corbitt said, you know, one thing about this, it takes a lot of the emotion out of it.
Yeah.
I mean, if you know, that's one thing, if I go out and I sell the board or I buy puts, or, you know, I can always get out of those. And most of the time I do, probably at the wrong time. But you know, in the LRP, you don't have to pay for it till the day it expires.
Right.
And you can't touch it. So, you know, it takes a lot of the emotion out of the market, and, you know, you sleep a lot better if you got a few of them.
Well, when I looked at we were going to be talking about these LRPs, and I just looked back, because I get a text that just what they are every week. And I was looking back, 1st of March, you could have protected your yearling steers coming off grass at the end of the summer for $1.80. It would have cost you $6 and change,
Right.
100 to do it. Who cares? But, you know, we were crazy to think they were going to pay us $1.80 for yearlings coming off grass anyway. And then
They're not gonna bring
and
that?
it's not going to do it. No, I'm sorry about that, buddy.
Yeah,
You'll be all right. Commission's
No.
steady.
you can, because, I mean, we've got several that was $1.84 for them August grass calves coming off Flint Hills.
Yeah.
You
Pay
know,
$6, you're still going to get 75 or better. Yeah.
You know, coming off at 8 weights at 6, you know, that's $48 a head.
Yeah.
That's a lot of money, but
But you can
now-
enjoy
now
your
we're
summer.
back.
Yeah.
Now we're back, you know,
Right.
quite a few dollars, maybe $30 by the time it gets back. And but anyhow, go ahead and go to the next slide, and we'll talk about some of the benefits. We kind of touched on.
Why don't you flip? Let's go one more and then we'll come back to this one. We'll make him happy over and talk about the subsidy.
Okay.
He's right, though. We didn't talk about, we were going to get to that in just a
That's
little.
right. Well,
Go one more, please. There we go.
there's your subsidies. So as you can see, the coverage levels, the bottom here, 95 to 100%, they're 35% subsidized. 40%, you guys can read that. But to get the subsidy, all you have to do is have an AD 1026 on file at the FSA office. And what that is a conservation compliant form at your local farm service agency office, and just whatever entity you have signed up in on your application is what it's got to be signed under. So that is all you have to do.
Yep. You know, well, yeah, when we quoted you those prices on the beginning, that was after the subsidy. So the majority of the time, like we ran these numbers in spring, me and Skylar, we were running puts against this, and the put would be just exactly about what the full price was. So it might just say those August cattle were about $10 or about $9 on a put, and we bought a lot of those for $6. So they paid about 35%. That because we were buying them at 99% on those cattle at the highest level you could buy them at. So, but if you back those cattle up, so we had 180, we'll just stay at 180 on those cattle. If you back those cattle up, you know, like we bought that lowest contract there, they subsidized that at 55%. That's why that premium was so low, because the more risk you take, the more subsidy they pay. Okay. So you can get up to 55% on those cattle on the lower, on that 7, you know, well, you would have been at about 50% because we're at 88% there, 45%.
45.
So we can't, they don't offer some of those contracts, but they're basically paying for half your protection, the government is. So, you know, when me and Brian first started talking about this, we were going to go over to a meeting in Mountain Grove, and I said, we got to go over there and convince these people that the government's going to make this better for them. And I'm like, oh, well, this is going to be fun. but we actually sat there and we worked through this, and we were talking about it. And it's $100 an acre to fertilize this fescue this year. They're at 50 at the least, and that's not much fertilizer. And that's pretty fair to say for all of us talking here about that. That doesn't take many acres of that fertilizer and a little bit of this $4,000 land or $3,000 or $2,500, wherever you're located at, for your $5 diesel in your tractor. You better have some protection on the bottom side of this. You know, some people can stand it, some can't, but you know, we came over and we sat with about 40 bankers about 3 weeks ago, and it was they had concerns. It's just the highest input cost they've ever seen in history. So, and cattle maybe aren't the highest they've ever seen in history by far, but it's a pretty close margin on these things, and that's what we talked about. And so they were glad the government was helping subsidize part of this, so we could buy that for $3 or $4 versus $5 or $6, and they're paying for about half of it. That's where we kind of got a little bit deeper into it as we do crop insurance, we do every other kind of insurance or ag related, but this has got where we felt like we're trying to help our producers protect themselves. And that helps everybody involved in the game. We've talked about it over and over. I mean, about this it's pretty volatile. The day Ukraine happened, I don't know how many cattle we did that morning.
It was a busy morning.
But probably 30, 40,000 head of cattle in about a matter of an hour. Now, this was one of the other things, and I never really thought about this. We were having a meeting the other day over there at Mount Vernon, and one of the things, and Corbitt will really probably follow along this, you can't buy the board if something happens until the next morning. It's going to open limit down. This is locked in till 9 o'clock the next morning. From 4 o'clock till 9 o'clock, you're locked in what you can buy it at. Now they got a $6 million a day subsidy maxed out. So everybody in the United States is buying it that morning. They went ahead and honored it because they blew through that $6 million in about an hour that morning. But they went ahead and honored it, the government paying their side of it with our crop insurance companies. But if something happens in the afternoon of that day, after that board, it's locked in till the next morning at 9 o'clock. So now listen, we may not be able to get, we're answering the phone as fast as we can. It starts usually ringing about 4 in the morning, those kind of days. But it's the one thing that kind of protects you that next morning, because you're going to be trying to buy that thing. It's limit down and you can't even get it bought. It doesn't matter at what price, or get it sold. So that's one of the other variables that we talked about. We're kind of getting off track from what we're doing, but that was one of the things that we saw as a huge advantage after we sat there and we kind of worked through that. And we think that's a great opportunity to, if some event happens, and there's a lot of events happening anymore, and probably always have been, but that's pretty nice to have that opportunity in the evening to get that thing locked up like that. So
Well, it's pretty huge. I think Skylar made a point of that. Corn jumps overnight 30 cents or 40 cents, you automatically know cattle's dropping if it's short term, or something major happens overnight and you see it, and it's going to be a long-term effect. You can jump in and cover yourselves and the next morning, or call me at midnight, I guess.
But all you guys that felt like it was unfair that the row crop farmers are getting so many supplements, this is a little bit of a
This is your guys'
offset.
crop insurance.
This is your cheese check.
Yeah.
If you don't get it, somebody else will.
Yep. There's only two things that cattle producers, livestock producers really have crop insurance in from the crop insurance side from us. That's PRF and LRP. That's the only two things that I have to offer for the cattlemen. So, but
let's roll back one slide if you don't care. I'll let you run through that.
yeah, it is available for everybody in here for all 50 states. It's for feeder cattle and fed cattle. The feeder cattle, they break it out by the steers and heifers. Then you got predominantly Brahman and predominantly dairy cattle. And then we break it out in different weight classes for the feeder cattle, 0 to 500 and 600 to 900 pounds. And then fed cattle is just 900 to 1400. And then something new to the feeder cattle there about a year and a half ago are the unborn calves. So for you cow-calf producers, let's say for you getting ready to start fall calving here in 3 months or so, you can go ahead and get an LRP on your unborn calves, let's say for next spring. Now that weight class is for $5.99 down, but you can go ahead and protect them unborn calves for next spring. So if
And the $5.99 or $5.99 down is 10% over the market.
yes,
steers.
well,
Over the board.
yeah, over the board.
Yeah.
On steers. But
On
not
steers.
heifers,
On
right?
steers,
Not heifers.
Not heifers. Heifers are even. But on the unborn calves, it's steers, heifers combined. You don't break them out.
Right.
Okay, it's an average price.
Right.
I think I looked for like March. It's like $1.84 or 85 for next March for unborn calves. So for let's say a 550 pound next spring that's steers and heifers both. That's probably not too bad.
We ran a bunch of it this spring there in February for those calves that are being born in March. We figured those October cattle at 550 pounds. And October's usually a pretty tough month to market something. We had them at 215 at one point. We could have got to 215 on those calves. Would have cost you about $45 or $55 a head on those cattle after the subsidy on those cattle. So that's a concept that everybody's still getting used to, is marketing those cattle like that. But that looks pretty good right now. A lot can happen between now and October, but you would have had that opportunity to catch that spread on that come fall. So
Go back one more. Just real quick, and we've touched on most of this here. The benefits. The big thing is banks they like this much more than puts and options and hedging. It's a safer. They understand insurance way better. The other thing is it fits all producers of any sizes, and so those are the two main things really.
Well, you know, one of the things that you don't pay for this until the contract expires. So either the crop insurance company sends you a check for the difference or what you made on it, or they send you a bill for what you knew up front, and that's the max cost you're going to have. It's not like whether it's a put or a call, or whether you have margin calls. You're not trying to figure out, when to get in a position, out of position. And like Scott said, it takes the emotion out of it. You pick it, that's what it is. Within that 60 day of the end of the contract with your cattle, you can sell them or you can keep them if they're feeder cattle. You want to take them on and feed them right on through, it doesn't matter. That's your choice with the cattle, just so you own them within 60 days of the end of the contract. And that's one of the things that we've talked about over and over about this, is that that opportunity is huge.
It is, absolutely. And the last thing is we'll touch on real quick, is it's very simple to get signed up, and we've got applications here too, if you've actually got them in your folders here. It's a one-time application to fill out, and once you do that, we're ready to do contracts at any time, and give any of us a call. And
one of the variables that does for you is if we have that filled out, and just say you're not ready to buy it today, okay? But if we have that filled out and we send that in, then you can call, just say there's a rust like Ukraine was. We don't have to try and get that filled out and send in that morning. All we have to do is send it basically a one-page endorsement in, they call it, and your cattle are on. You're locked in right then. Otherwise, we got to get that filled out, get it sent in.
Yeah.
We can get it done. Don't think.
I can do the endorsement in about 2 minutes, but if I got to do the policy and the endorsement, it takes some time. And when you've got a stack of phone calls coming in, it can delay it. Get the policy in. You're not tied to anything by getting the policy in.
You don't have to buy anything.
You just have a policy number.
Yep.
But get it in, so if there's an emergency, something happens, you're ready to go. So, anybody have any questions on the LRP?
You said it's good for 60 days on either side of the marketing date?
No, just you have to retain ownership 60 days. Go ahead. We're going to bring you a microphone so everybody can hear that.
So your policy date that you pick, you've got 30 days on either side of it, or 60 days on either side to market your cattle?
No. On the 60 days, you have to retain ownership within 60 days before the end date. So let's say we had the end date of August 15th. You have to retain ownership until June 15th. Okay?
After that, you can do whatever you want with the cattle.
If you don't have to sell the cattle before August 15th. You can retain them and do whatever. You can retain them and take them on to the feed yard if you want. Okay?
So if you sell them on June 15th and your target date was August 15th,
Yeah, as long as it ain't more than 60 days.
then your payment off the insurance comes on August 15th though.
Yep.
Yeah, your ending value comes on August 15th. Okay?
Well, Corbitt was wanting to kind of go over some stuff here, but we want to, you guys have any more questions as we go here? There's a lot of different variables here. You're going to think about more stuff. We'll let him visit a minute, or there's another one over there. Sorry.
Okay, so I've got policies for $1.70, and I sell those for $1.60. Do you pay me $10 a hundred, or how's that work?
No. Go ahead.
No. Whatever the CME index was, it didn't. So that 12 state or 7 state, really 7 state average on those cattle, whatever the CME index is, they pay against that board, and they figure it. So your cattle, however you market your cattle, because here's the catch in the deal. So if you're selling unweaned, fat, uncut bull calves in October, he's not very valuable. So they can't really go off your exact cattle. Everybody's got a different class of cattle that you market. So, or you've got weaned calves in October that have had every shot in the world. There could be a $40 spread in those cattle. So what they do is they just take that average, that CME index, that 7 state average of those cattle, and that's how you get paid back. So it takes the variables out of how everybody markets their cattle completely different. They've got their own scenario. So that's why they do the CME index against the board on the day you pick. and you got 7 days leading up to that on the index that lead into that, and it does make it where not just one day knocks you out of it. You got a 7-day trend there. So,
All right. We'll
Any
go ahead and
more
let
questions?
Corbett talk then,
Well, I
and
think we
then
got-
we'll go back to the.
Anybody got any more questions on the LRPs? I mean, we can ask them a little bit later. I was just gonna talk a little bit about some things that are going on right now. I don't know if you noticed that yesterday they marked up, which means the House Ag Committee had a vote on that special investigators bill that was kind of a sister bill with Cattle Price Discovery and Transparency Act. What it basically does is it gives USDA subpoena power, mostly against packers, when they're investigating this collusion and unfair trade practices and all that kind of stuff. Now, NCBA and KLA and all of them were totally against this, but they brushed them off and they went ahead and marked that bill up and approved it. So now that bill is going to be going into the House of Representatives for open vote. So we'll see what happens there. We feel like that bill will have an easier time going through the Senate also. But the fact that bill went through the House Ag Committee as quick as it did, it gives us a good idea that this Cattle Price Discovery and Transparency Act that I talk about all the time will have a similar effect whenever it comes. They think that they will brush them off, even though they got a strong lobbying group, and we'll go ahead and get that marked up too and then sent on for vote. So that's the bill that I talk about all the time that will mandate that packers buy a certain percentage of their cattle through a negotiated manner instead of just all these sweetheart deals that leave us kind of lost on what the market really is. We need to know what that market is so that the guys that are buying yearlings will know what to give for them, and the guys that are buying calves will know what to give for them. But that's kind of the latest update on the legislation that's going through right now. And you guys keep watching that. It's going to affect you as cattle producers going forward. But everything affects the market, and especially feeder cattle. Some little deal can happen in some country you never heard of on the other side of the globe, and it'll kill your feeder cattle market. And we put so much pressure on that market anyway through hedging, it doesn't take very much to tip it over. And another reason I like these LRPs, of course they're having to do it, I'm sure, on the insurance end to protect themselves, but there's not so many individuals pushing down on the market through hedging, which I think is a good idea. So we can take any questions you want on the LRP, or I'll take any questions you have on anything else here while we're here.
I have another question on, our little operation. We've got some fall covers, like you mentioned. So on those fall covers, how does that look like protecting that in the spring, you said?
Mm-hmm.
Can you walk through that a little bit?
yeah, that's what we were talking about a minute ago. That on those unborn calves for the fall cows, and you may not pick a month actually so far out there, but if the board looks good in certain months after they're born, and we'll figure an ending weight on them. Those cattle, we can pick that for the spring on the unborn calves. They figure them 50-50.
Yeah, if you do the unborn calves, it'd
Unborn
be,
calves. So it gives us an opportunity to pick that price for you. And you can pick that month. You want to market them in the spring. They can only, because it's only 52 weeks, and we got to make sure there's a contract offered. So we're a little close to spring right now. Another 2 or 3 months, it'll be a month or two, I believe, to get contracts issued.
I can do a March one right now on
March,
unborn
as far as
calves.
we can get out there right now.
About 43 weeks is what they was offering last night. So we was missing two periods.
But the farther we go towards fall, you can do that easier in the spring.
Right.
You just pick, and we'll pick the board, and it goes off that. So.
Yeah.
All right.
Oh, we got one.
Can I get a quote today?
Yes.
Yeah.
We'll be out in the hall, out there. Just let us know. We can quote it. We have 2 people or 3 that are sitting out there. We can go out and quote. If you want to run some scenarios and some numbers, let us know. And then the other thing is, you can, on our website, we have the ending values every day on there. We keep it on our website. It's updated. We built a crawler on the back of RMA's website, basically, that gathers that data, and it's accessible through our website every day. But we can go quote anything you want in the back, and we can follow that piece of it for you.
Kevin, is there a certain time of the year that's better to do these LRPs than others?
I don't really know.
I saw you probably
That's
asked.
Skylar.
Well, I mean, as far as the index goes, you know, like a heifer's 90% of the index, or 90% of the coverage
90%.
price, which, you know, when we got up there to 185, it didn't look like a very good deal because that was $18.50 on a heifer. So, but you know, if you get out there in the summer and you got some heifers on grass and you're going to buy an LRP, and I had a lot of guys told me this that had heifers on grass out there that didn't quite understand it, and they were quoting them. Well, I think when it was 183, it brought it all the way back to like a 160, or, you know, a coverage like that didn't look like a very good deal for $30 a head. But what they didn't understand is when you got to that point, whatever the index was that day that you picked, that heifer was worth 90% of it. So if it was 160, what's 10% off 160? 144, it would have been your where they'd have paid you at off the index. So, you know, certain times of the year, the base is just going to be better. I mean, and if there's a lot of cattle moving in the north that's got that index real high, right? Corbett probably know more about, you know, this than me, but to get this index real high, then we struggle competing with that index in this area because there's a lot of cattle that's moving right against the feed yard that's really good quality that's keeping that index pumped up. In the springtime, we got a lot of cattle that's getting marketed across the southern plains, Texas, that's coming off wheat that typically, you know, brings that index down a little bit. Probably the only thing that's keeping the index where it's at right now is people buying 725-pound steers to go to grass. Mm-hmm. If they weren't in that index right now, it would probably be $1.47 or $1.48, wouldn't it?
Right, for sure.
So it just kind of depends on the time of year. You know, typically if you've got grass cattle in starting July 1st, you know, September 1st, you know, and you can expect a pretty good basis through that time period if you got some condition and good cattle. So,
You know, that kind of led into the second question is, and I don't know that maybe you touched on it so much, but you mentioned the 90%. I saw steers and I saw heifers up there. Can you explain how that works between, because you've got one CME feeder cattle index, right? But you can write a contract on a steer and a heifer. Can you explain how to settle the difference between the steer and the heifer contract?
So your heifer weight ones, which is 0 to 599s, and your steer weight twos, which are 600, 900 pounds, they're even with the index, whatever it settles at. Then your heifer weight twos are 10% back. They're 90% of the index. And then your steer weight ones are 10% above or 110% of the index. Okay? There's adjustment factors there that totals out.
Clear as mud.
Which that could change once cost of gains get to be more than the price of fat cattle.
well, you're pretty negative.
One thing I didn't touch on, we didn't touch really a lot on fed cattle, but the fed cattle does settle out on the 5-area weighted average. It is not on the CME index or anything. It's a 5-area weekly weighted average.
You know, if you look at an 850 weight heifer today, they bring $1.35. Well, that's quite a bit back of the board, but like a big heifer this time of year, she hits an August live cattle market or, you know, an early fall, which isn't usually very good now. She's up against high feed costs, so you're looking at a big basis spread right now on a big steer or a big heifer, and that's typical this time of year, you know. So a lot of it just depends on the time of year and what's going on.
I'd say any time that board gets up there and starts looking pretty handsome, and you're thinking, no way they're going to give me that for them. That might be the time to do it.
Surely we're going to get your outlook on the markets, aren't we?
It's about like what Skylar said. It's kind of bearish right now, guys.
This is the best next year business ever created. Who in here thinks it's going to be better in 2023? Raise your hand. Thank you.
Guys, we appreciate your time today. We got is there any more questions?
No, just if you go.
Oh, yeah, go to another, yep, there you go. These are two websites that you can go to. This is our specialty risk website. We post the daily LRP prices every day on there. This is the RMA website. Same thing. And then go to the next. If you scan that, it automatically signs you up. Is that right, Sam?
Yeah, you just have to enter in your name and phone number.
Enter in your name and phone number. We send out a weekly text caster, midweek LRP update. We shoot about every Wednesday. I'm supposed to. Sometimes I miss a day. But you get signed up on that, and we just kind of give you a little midweek update on the LRP.
But all the data, daily data is up there on the LRP, so you can look at that anytime on our website. And like I said, on Wednesday we try and have just a little quick, but usually 3 or 4 minutes, talks about what LRP's done that week, what you can buy it at, what it's looking like. If there's anything major on these settlements, we're starting to see more settlements come through, how that's looked for the week. So anything you want to hear about on there, just let us know. We want your feedback. So we're trying to build this thing and give that data to you and make it available to you. So. Any more questions? Anybody got any more questions? I missed anything, Sam? Sam and Mark have kept us in line all week.
I think that's about it.
Corbitt, we appreciate you coming up here from Amarillo.
You bet.
And Skylar.
Skylar, thank you.
Yep, thank you guys. You guys got any more questions? We're going to be around here at the door here in a little bit, or be out in the hallway, and we'll be glad to answer anything. We appreciate you guys' time. Thank you.
Yep, thank you.